Hello and welcome back to the channel. We have just a very exciting, exceptional video for you today. And what this is about is interest rates. We know that they are not where we want them to be, but I'm bringing in an expert and we're going to talk through what is going on in the market, what are the possibilities of somebody who wants to make a move, and is it as bad as we think that it is? And so I'm bringing on, this is our special guest. His name is Scott Digregorio from Neo Home Loans. He's been doing residential mortgages in our industry, in our area, for over 25 years, so certainly an expert on the matter. Let's jump right into it. So Scott, thanks for joining. Really
Welcome.
happy to have you on. And as I mentioned, Scott is an expert in the field, and I just thought he'd be such a good resource for us to understand what is going on in the mortgage world. It's not great for everybody. Let's just start off by saying, it's not pretty, but there are some options, and we'll get to what those are, here in the conversation. But if you can sort of give us a little history. How did we get to where we are today?
Yeah. So look, a lot of people think that interest rates are affected by a lot of different things. And the reality is what's impacting rates right now is inflation. Inflation came out a couple of years ago. In my opinion, the Federal Reserve reacted too slowly to it. They thought it was going to be short-term and not long-term. They didn't react for about 8 months, and I think that put us in this position. And whenever we go through the stimulus money that we went through with COVID, supply chain efforts, countries like China getting shut down specifically, those are just massive inflationary events.
Well, the amount of money that was injected into the system, there was some stat, and you might even know it off the top of your head, but it was like 80% of all money that's ever been minted was minted during a 6-month time frame and injected into the market.
Absolutely. And when you just start sending out checks to everybody, what most people do is they go out, they just spend the money. It just creates an imbalance between supply and demand, and that's inflationary, and that's how we got where we are.
Well, and the reality is, and I talk about this often, is it's actually necessary for us to go through a cycle, right? If everything was just full burners on, where do we go? I mean, that's when you have a crash scenario.
Sure.
And what I'm seeing on my end of things is I'm seeing, obviously rates have come up, but the real estate market is staying in a fairly steady place and a healthy place at the moment. We're not seeing prices go up. We've seen them come down a little bit year over year, and I would expect that. But, when it was going up 30% year over year, that's just a long-term problem.
That's a problem.
Yeah, that's a problem. And so nobody has that crystal ball. You can't predict 100% of the future, but where do we think that things go from here?
Yeah, so although there is no crystal ball, Brad, there are some indicators that can be watched that are extremely reliable. And as you know, I'm a bit of a data nerd. Yep. So if you look at inflation
I don't
in
know
the
about
way
the data part, but
I'll take it. But look, if you look at inflation, right, the way inflation is calculated, they literally take the last 12 readings and add them together. So what that means is when the September 23 number comes out, the September 22 number falls off. Mm-hmm. So if we look, we have 2 more months of high inflation numbers from last year that are left. So in the next 90 days, the high inflation will be over. And that should start a downward trend of interest rates. Now, the unknown part, Brad, how far down, how quickly, we're walking into, or we're in an election season. The war between Russia and Ukraine is a factor. There's a lot of political and geopolitical forces at play here. Yeah. But to say that rates will come down is pretty widely accepted. And I know Fannie Mae says that they'll come down to 4.5. Zillow, I think, says they'll come down to 5.5. I don't know where they'll come down to, but we should see some definitive release here in the coming months.
So what happens then? What happens when those rates go from, where are they today?
Call it 7, give or take.
Okay, 7%. What happens when those rates go to between 4.5% and 5.5%?
Well, from my standpoint, lots of refinances, which is good. But from a real estate market standpoint, Black Knight actually did a study on this, really interesting. And what they found was they looked at, I forget, 170 some odd markets. I forget the exact number, but they looked at median income and median sales price. And they said, okay, on today's interest rates, this many people could afford to buy a home. But if interest rates came down by just 1 point, the amount of new buyers that would then be eligible to buy a house increases by 5 million buyers. Oh. Now, compare and contrast that to the fact that last year we only sold 5.95 million homes in America. So we're talking a doubling of the buyer pool, which is going to lead, in my opinion, to a crazy hot market again.
So there's two sides to that from my perspective. So number one, we have a lot of new buyers that enter the market who are now able to afford, a payment, an interest rate that some people may not be able to today. That's accurate. But the second side of that I see is that opens up the potential of sellers being willing to sell their properties. Yes. Because what the scenario that we've worked with a lot lately is we see, it's like 80% of all mortgage holders out there have less than a 5% interest rate. And so if you have a 3.5%, I think it's 50% of the mortgage holders have a 3.5% or lower. And if you have that low rate, how likely are you to sell in order to buy something at a 7% interest rate?
Sure.
Pretty low, right?
Yeah.
And so what that has done for us is that's restricted a lot of the potential inventory because the sellers aren't willing to sell in those scenarios. And if we get that scenario where, hey, the interest rates come lower, that may relieve some of the inventory constraint that we have while adding those buyers. But no matter what, that adds fuel into the real estate market and obviously prices thereafter.
Yeah, and Brad, you bring up something, we've never talked about this off camera, but you bring up something that is kind of near and dear to me, which is people feel trapped by their low interest rate in their home. Yep. And the conversation I've had with a lot of people is, I understand what the rate is on your home, but what is your blended interest rate? Consumer debt, credit card debt is nearing $1 trillion. It's at an all-time high.
I think just passed.
Yeah.
It just passed.
Oh, it just passed? It's been soaring. Credit card defaults more than 90 days late has just jumped up a significant notch. So Americans are carrying around more debt than ever before and are sitting on more equity than ever before. And I was just talking to a client recently. By the time I was factoring in all of their debt, their 3.25% mortgage actually was paying a blended rate of, I think it was 7.75.
Okay.
And
so you're taking into account the interest that they're paying on the other debts,
of course,
with their 3% interest.
Yeah. What is their mortgage? Do they have a home equity line of credit, credit cards, cars?
Putting all that together and then figuring out. Okay.
So what I explained to this client was, you could sell your house instead of taking all of the proceeds and putting it into the next one. Let's wipe out your debt. Right, be careful with the right debts, obviously, but let's wipe out your debt. We were able to, yes, put him in a higher interest rate, but free up his cash flow to the tune of $1,500 a month. Wow. And then explain to him that once the refi is done, when that happens, 3 months, 6 months, 12 months, it's going to happen. We could lower him another $600 to $800 a month. And it's really the best of both worlds versus the other scenario where, hey, now I'm willing to sell because rates have come down, but as a buyer now, you're in an ultra-conservative or competitive market.
That's an interesting point that I haven't really thought about, and we're seeing it more and more where it's challenging out there right now. It's challenging, and inflation is sort of going away, but it doesn't mean that we're still not paying a whole lot. Sure. McDonald's costs you $40 or $50 to take your family there. It's an expensive thing. And so what's happening is there are people who are taking on debts just to get by. Yeah. And I see, they're sort of responsible versus irresponsible debt. Some people say all debt is irresponsible, but I don't truly believe that. And some people you got to do what you got to do to get by. And it brings me a story. It was probably about a year and a half ago. We helped a client who was in pretty significant debt, and they were in a spot where they had a lot of equity in their property, and they wanted to make a move. And so with the equity that they had, they were able to wipe away all of the 20% interest, debt that they were paying otherwise, and do a reset. Yep. And part of that reset, it gives them the freedom to get out from underneath that cloud of debt, but it also gives them a chance to reset. Right? Because a behavior, from my perspective, a behavior that, let's say that it's irresponsible debt. Let's say that they're doing things that, hey, I want to do an upgrade to the house, or I want to do something. That to go into debt, over time, you can see the position that they put them in. And if, quite frankly, if they didn't have the equity in their home, that would have been a very long-term problem. And so we're in a fortunate spot in the market where so many people have tremendous amount of equity that they can, sell or tap into, and there could be a scenario where a refi even makes sense at a higher interest rate. Right?
Yeah, I mean, look, I've heard this story from plenty of clients who have done debt consolidation refis for. Scott, I survived COVID. Scott, I survived inflation, but I couldn't survive Ian. Right? I mean, we got hit with a 1-2-3 punch here in Southwest Florida in a pretty significant way. And again, lots of clients, yes, am I raising your rate from 3% to 6.5% to 7%? Yeah. But what is your monthly cash flow looking like? And then, if we took some of that savings and maybe spoke to a financial advisor, maybe invested some of it to offset it, and then we do a refi down the road. I mean, I've done projections for people, Brad, where they end up hundreds and hundreds of thousands of dollars ahead by refinancing out of their low interest rate. But like you said, it's all about doing it responsibly. You can't refi and save a bunch of money, in my opinion, without having an intelligent plan on what to do with the money. Otherwise, that money just vanishes, and now you've stepped in the wrong direction.
Well, and God forbid you keep it as cash.
Yeah.
Right? Like that's a terrible thing too, because of the inflation issues that we have. That's one of the things that I have always appreciated about what you do with Neo is that planning and those projections that come into play. So talk a little bit about how that works.
Yeah, so I got my certified mortgage planning designation back in 2015, and the mortgage industry tells people what they can do and not what they should do. There are massive bills that are not taken into effect in people's debt to income ratio. I have 3 kids, 2 of them are in college, all 3 kids are on my car insurance. I'm self-employed, so my health insurance you could identify as not a small bill.
I feel you.
So those are honestly, my 3 biggest bills in my life right now. None of them are on my debt to income ratio. So slinging debt at somebody without looking at their holistic situation, in my opinion, should be malpractice. It's just wrong to do. The other piece of it is, I think 91% of Americans never talk to a financial advisor. So people are going around, there's no fiscal literacy taught in the school system. There's no fiscal literacy taught in America. So they're walking around making decisions that will dramatically impact their future, and they're making them from a standpoint of no knowledge. And it's no fault to them.
Right.
You don't know what you're not taught, right? You don't know what you don't know. So I do a lot of that planning and advising for people, and I'm not a financial advisor and all that type of thing, but I know that this profile should speak to an estate attorney, and I know that these debts have to be taken into consideration. Yourself, Brad, you have triplets, right?
I mean, that's accurate.
How old are your kids?
They're 8 years old.
Okay, so, 10 years from now, you have a significant college bill coming.
I was feeling really good about this conversation. Thanks.
But I mean, I would never put you into a mortgage without having that conversation. That conversation needs to be had.
Sure.
And maybe the conversation is, hey, Scott, that's handled. They've done A, B, and C. Cool, let's check it off. But to put you in a mortgage without factoring in that bill, it may feel good now, but 10 years from now, it may not.
Right. And the blinders, right? And those blinders are not put on by necessarily the people, but it's the lack of education around things. And it's not knowing what you don't know. It's not, I believe that people always make what they believe is to be the best decision given their own knowledge. And that may be an optimistic way of looking at life, but that's just the way that I choose to do that. And people, they feel like it's the best thing. They may want a bigger home because they feel like they'll have more space for the family, but maybe that bigger home isn't the right long-term solution to help the family. They think they're helping the family, but they're hurting the family by getting themselves into that.
Yeah, and look, I mean, it's well understood that people make emotional decisions and then find logical reasons to support that emotional decision.
Does that happen?
That's a thing.
Oh, okay. Got it.
So we should not be doing that with our retirement and our future. I watched my parents die broke. I watched my grandparents die broke. And the truth is this, it's with just a couple of the right moves, and the earlier the better, obviously, you could be comfortable in retirement. And after having witnessed that with my family, that is just a lifelong mission of mine, is to help as many people as possible avoid that same scenario.
That's awesome. And a lot of that can be delayed gratification, and we're terrible at that. That's not a very good thing. So anything else that you feel like we should be aware of in terms of the mortgage? Is there anything planning wise that somebody should do? Because rates are where they are, but that doesn't mean that there's no options for people. And on my real estate side of things, it doesn't mean that we can't negotiate with a potential seller to help in the scenario with rates. And so a lot of people don't understand that. Can you explain?
Yeah, so two things as far as advice for people. Number one, be careful just blindly accepting what the financial media is reporting, because unemployment data and type things like this, if you get really deep in it, are a little different than like the official numbers. But specifically to your point, Brad, I think that people need to start planning. You use that a lot in your question to me, and I think that's the takeaway. If you're ready to if you're thinking about buying a house in a year, you're thinking about selling a house in a year, let's start the conversations today. Maybe a year is too short, maybe it's too long. Maybe there's things we could do today to maximize that. Maybe you walk into a house, Brad, and you go, listen, change A, B, and C in your house, and it's really going to maximize the selling potential. Right. I think so many times we wait until we're ready to do the thing before we start planning.
Well, they find a house that they love. They find a house that they love and like, hey, I want to do this. And there's a lot that goes into it prior to that. Absolutely.
And I've had too many clients come to me in that I found a house, I love it, we have to make it work. No, let's step back from that love. Okay, let's look at things here. I think planning is a really critical thing, and I would love everybody to be talking to me a minimum of 6 months before they actually are ready to do something, so we could make sure we have a really well thought out, cohesive, non-emotional plan in place.
Well, and we've seen time and time again where people who have that conversation early, oh, there's a medical bill that was, not paid, and it's $12, and it's negatively affecting the credit, and now we can put a plan together to be able to deal with those, as opposed to like, hey, sorry, we can't do a loan. You can't buy this house. We can't do that.
Exactly.
And so that conversation, we get, on the real estate side of things, we get into the picture, early on, and we always want to wrap in the lender, and you're welcome to use anybody that you want. Obviously, Scott has tremendous expertise, and we recommend him, but that picture of having the right agent on your behalf and having the right lender to be able to forecast and be able to get ahead of potential problems, I can't talk about how important those two things are. I mean, it is, and that's what we do. So, this isn't even like a sales pitch for us as much as like just make sure whoever you choose has their act together and can understand that and help plan and forecast accordingly. Yeah,
look, a lot of people view our two industries as commodities. Whoever's cheaper is better, and these are. I'm usually giving people the largest debt of their life. You're usually helping people acquire the largest asset of their life. These are not commodity things, right? I mean, if God forbid a loved one was diagnosed with something, you wouldn't look for the cheapest doctor. You'd look for the best doctor. And I would say that people's financial health is not certainly as important as their physical health, but very close. I mean, the number one cause of divorce in America is money. So I really think that getting people around you, like you said, that are going to advise you at the highest level is such a critical thing for people to do. Yeah, that's awesome. Well, listen, I really appreciate it. Hopefully you got a lot of value out of this session, and I want to do more of these types of conversations. So make sure to comment below. Let me know what your questions are in regards to mortgages, and also what other topics are you looking for. And as always, make sure that you like the video, subscribe to the channel, and make it an awesome day. Take care. Talk soon.